Welcome back to the channel. Before we dive into today's huge crypto story, I want to take just a moment to apologize. Yesterday's episode wasn't up to the standard we set for you. There were some production errors, and parts of the content didn't flow as smoothly as it should have. We know you give us your time every day, and in return, you deserve quality, clarity, and value. So I'm holding my hands up. Yesterday was messy, and that's on us. We've tightened things up, and today we're back on track with what you expect. Clean delivery, big insights, and stories that actually matter. And believe me, today's story matters. Because nearly $900 million was just wiped out in liquidations across the crypto market. Bitcoin dipped under $110,000, Ethereum fell hard after brushing against a new all-time high, and altcoins bled red across the board. Traders who were over-leveraged learned the hardest lesson this space can hand out. When the tide turns, it turns fast. So let's unpack it. We'll go through today's top 10 snapshot. We'll break down exactly what happened with the $900 million in liquidations. We'll talk about how whales, ETFs, and the Fed all played their part. And then, we'll zoom out into the broader structural shifts. India's futures market, corporate treasury supply squeezes, and what all this means for where Bitcoin, Ethereum, and Solana go next. Let's begin with the market board. Here's the current snapshot of the top 10 coins by market cap. Bitcoin is trading just under $110,000, after falling 2.8% in the last 24 hours. It's still up massively on the year, but the volatility is a stark reminder that even at six-figure levels, Bitcoin isn't stable. Ethereum is sitting around $4,550, down 3.3%. But that still leaves it close to the all-time high it tapped over the weekend near $4,945. Ripple's XRP is trading at $2.93, down about 2% on the day. Tether and USD Coin are both holding their pegs at 99.99 cents. Binance Coin is at $853. Solana is hovering near $196, down 3.7% after it surged past $200 earlier this week. Dogecoin trades around 23 cents, Tron is at 36 cents, and Cardano is sitting at 91 cents. That's your leaderboard. Mostly red, mostly pain. Stablecoins steady. But the story isn't just in the numbers, it's in how the numbers broke. So what happened? In just a few hours, the crypto market saw nearly $900 million in leverage positions wiped out. That includes around $320 million in Ethereum longs and $277 million in Bitcoin longs, plus hundreds of millions more across altcoins like Solana, Dogecoin, and Cardano. Liquidations happen when traders borrow money to go long, expecting prices to rise. When the market dips instead, the exchanges force close their positions to protect the loaned funds. It's brutal, automatic, and when it happens at scale, it cascades. One forced close triggers selling, which pushes price lower, which triggers the next batch of forced closes. And before long, you have a waterfall. That's what we saw today. The spark was a whale move, a massive sell order. Estimates put it at around $2 billion in Bitcoin rotated into Ethereum, hit the market. That triggered a slide under key technical levels, which set off stop losses, which then triggered the liquidations. From there, panic did the rest. In plain English, one whale nudged the domino, and $900 million of leverage fell like a house of cards. This is the part of crypto most retail investors forget. Leverage is a double-edged sword. Yes, you can 5x or 10x your gains. But the market only needs to move a few percent against you before you're wiped out. And in crypto, a 3% swing can happen in minutes. The lesson from today? Respect leverage. The people who got liquidated weren't dumb. They were overexposed. They assumed the rally was unstoppable. They assumed support levels would hold. But in crypto, certainty is an illusion. If you over-leverage, the market will find you. Now let's zoom out. Why was the market so twitchy in the first place? The answer is macro. Last week at Jackson Hole, Jerome Powell signaled that the Federal Reserve is tilting toward cutting rates as early as September. That's good news for risk assets, but it also creates a weird environment. Traders pile in expecting cheap liquidity, but until the cut is confirmed, every data print and every speech is a potential landmine. So the market is edgy, the dollar is slipping, bond yields are wobbling, And crypto, being the most sensitive risk asset class of all, is hypersensitive. That's why one whale move could trigger 900 million in liquidations. Everyone was already leaning long, expecting easy money. The Fed's tone encouraged that. But when the unwind hit, it hit people leaning too far. Let's talk Ethereum. Over the weekend, it hit a new all-time high of 4,945. That's a major psychological milestone, and it happened on the back of record exchange-traded fund inflows, nearly $3 billion in a single week. But when the liquidation wave hit, Ethereum's leverage was exposed. $320 million in long positions evaporated in hours. Here's the paradox. Structurally, Ethereum is bullish. Supply is tightening because staking locks coins and ETFs are hoovering up what's left. But tactically, traders overplayed their hand. They assumed straight-line price action. They forgot that even the strongest bull markets breathe. Today's liquidation doesn't kill the Ethereum story. If anything, it resets it. Less leverage means healthier moves ahead. Now Bitcoin. $277 million in longs liquidated. Price dipping under 110,000. For some, that's a terrifying number. For others, it's just another Tuesday in crypto. What matters is that Bitcoin's role hasn't changed. It's still the bellwether. It's still the reserve asset that institutions and treasuries are buying. In fact, MicroStrategy added another 21,000 coins in late July, taking their stack north of 628,000 Bitcoin. That's not a retail trader YOLOing into leverage. That's a Fortune 500 company using Bitcoin as treasury collateral. So while today's move hurt the leveraged crowd, the structural bid is still there. ETFs, corporate treasuries, and now even governments with strategic reserves are providing a floor. Bitcoin's story isn't broken. It's just volatile. Always has been. Always will be. Then, there's Solana. Earlier this week, Solana overtook Ethereum in decentralized exchange volume, breaking a 10-month record. That was a huge narrative shift. It showed developers and traders alike were flocking to Solana's speed and fees. But when the liquidation wave hit, Solana wasn't immune. It dropped 3.7%, falling back under 200. The altcoin story is the same across the board. Cardano, Dogecoin, Tron, all caught in the liquidation cascade. When Bitcoin and Ethereum sneeze, the rest of the market catches pneumonia. That's just how correlation works. Now, here's an under-the-radar story that ties into today's volatility. In India, crypto traders are shifting massively toward futures markets. Why? Taxes. Spot trades are taxed at 1% on every transaction. Futures aren't. So Indian traders have migrated, and now futures volumes are 3 times larger than spot. That's not just a quirky regional detail, it matters globally. When more volume concentrates in futures, the market becomes more sensitive to leverage. And as we saw today, when leverage unwinds, the pain is amplified. Add to this the rise of crypto treasury companies, institutions that buy and hold Bitcoin for corporate or national balance sheets. Collectively, they now hold over 1.4 million Bitcoin, nearly 7% of supply. That's bullish for long-term price, but it creates a squeeze for traders. When supply is locked away, order books get thinner. And thin order books mean more violent moves. Today's $900 million liquidation is partly a function of that. Less supply means every big order cuts deeper. So what do we take away from today? 3 things. First, leverage kills. $900 million gone is a stark reminder that trading crypto with borrowed money is playing with fire. Respect leverage or get burned. Second, structure beats noise. Ethereum's supply is still tightening. Bitcoin's corporate and government adoption is still growing. Solana's developer activity is still surging. One liquidation event doesn't erase those fundamentals. Third, policy risk is everywhere. From Jackson Hole to London's sanctions to Beijing's yuan stablecoin discussions, the macro and geopolitical forces are shaping liquidity as much as whales and exchanges are. You can't just look at charts. You have to look at governments. So, let's wrap it up. Nearly $900 million liquidated. Bitcoin under 110,000. Ethereum off its highs but structurally bullish. Solana bruised but still building. India's futures pivot, showing how regulation reshapes markets, and corporate treasuries locking up supply, making every move sharper. Here's my question to you. Would you buy the dip after today's carnage? Would you fade the fear and stack Bitcoin and Ethereum here? Or would you wait for clearer signals, maybe even rotate into altcoins like Solana once the dust settles? Drop your view in the comments. Smash like if you value honest coverage, even on messy days like this. And follow so you don't miss tomorrow's analysis. Because the one thing I can guarantee in crypto, the story never stops. We'll see you at the top.